Oil prices are back at the center of Wall Street anxiety. Every time a geopolitical headline appears, markets react almost instantly. A conflict escalates, oil jumps. Shipping routes face disruption, stocks fall. Sanctions are announced, volatility spreads across global markets. And investors are becoming increasingly nervous about how closely energy prices and market stability are connected again. Because oil, geopolitics, and Wall Street volatility are now colliding at the same time. For years, many investors became comfortable focusing mainly on technology stocks, AI growth, and interest rates. Energy markets still mattered, but they weren't dominating financial conversations the way they once did. Now that's changing fast. Oil prices have become one of the biggest uncertainty triggers in the global economy again. And the reason is simple. Oil affects almost everything: transportation, airlines, manufacturing, shipping, food production, consumer spending. When oil prices rise sharply, businesses across the economy immediately feel pressure. Shipping becomes more expensive. Airlines face rising fuel costs. Factories pay more for operations. Consumers spend more on gasoline and energy bills. And when consumers spend more on essentials, they usually spend less elsewhere. That's why Wall Street reacts so aggressively to sudden oil spikes. Because higher energy costs can slow economic growth very quickly. But the bigger issue right now isn't just higher oil prices themselves, it's unpredictability. Markets can usually adapt to expensive oil over time. What markets struggle with is instability, and geopolitical tension creates instability extremely fast. Conflicts involving major oil-producing regions immediately raise fears about supply disruptions. Investors start worrying about shipping lanes, sanctions, production cuts, or broader regional escalation. Even the possibility of disruption can send markets into panic mode. Because financial markets don't wait for problems to fully happen anymore, they react to expectations immediately. And today's global economy remains heavily dependent on stable energy supplies, even as countries push toward renewable energy and electrification. That's something many people underestimate. Electric vehicles are growing, renewable energy is expanding. But oil still powers huge portions of the world economy. Planes still need fuel. Cargo ships still rely heavily on oil. Industrial supply chains still depend on energy-intensive transportation systems, which means oil remains deeply tied to inflation, business costs, and investor confidence. And Wall Street knows this. That's why geopolitical tensions now ripple far beyond the energy sector itself. When oil prices rise rapidly, investors begin reassessing the entire economy. Will inflation rise again? Will central banks delay interest rate cuts? Will consumer spending weaken? Will businesses reduce hiring or investment? Suddenly, a geopolitical event happening thousands of miles away can impact nearly every sector of the stock market. Technology stocks can fall, retail stocks can weaken, airline stocks often react immediately. Even bond markets shift as investors rethink economic risks, and volatility spreads very fast in today's market environment. Part of the reason is that markets are already operating under pressure from multiple directions. Interest rates remain relatively high compared to recent years. Governments are managing massive debt levels. Businesses are spending aggressively on AI infrastructure. Global supply chains are still adjusting after years of disruptions. So when oil volatility enters the picture, it adds another layer of uncertainty into an already fragile system. And uncertainty changes investor behavior quickly. During stable periods, investors focus heavily on growth. During unstable periods, investors focus on protection. That shift can happen almost overnight. Money moves into defensive sectors. Investors rush towards safer assets. Volatility spikes across equities. And companies with weaker financial positions often come under pressure first. This is why oil shocks historically create outsized reactions on Wall Street, because they affect both economics and psychology at the same time. Higher oil prices don't just increase business costs, they also increase fear, and fear spreads quickly through financial markets. There's another major factor making this situation even more complicated now: global power competition. Energy is becoming deeply tied to geopolitics again. Major countries are competing over supply chains, shipping routes, energy infrastructure, and strategic influence. Sanctions are becoming more common. Trade relationships are shifting. Countries are trying to secure critical resources and reduce vulnerabilities. That means oil markets are no longer driven purely by normal supply and demand. Politics now plays a massive role, and political uncertainty is extremely difficult for markets to price correctly. One sudden escalation can completely change market expectations overnight. That's why investors are reacting faster to geopolitical developments than they did during more stable years. Markets understand that energy stability cannot be taken for granted anymore. At the same time, oil volatility is complicating central bank decisions. When inflation rises because of energy prices, central banks face a difficult balancing act. If they keep interest rates high to fight inflation, economic growth could slow further. If they cut rates too quickly while oil prices remain elevated, inflation pressures could return again. That uncertainty creates tension across financial markets. Because investors are constantly trying to predict what central banks will do next, and oil prices can suddenly change those expectations very quickly. One week, markets may expect interest rate cuts. Then oil spikes sharply, inflation fears rise again, and expectations shift completely. That constant repricing creates volatility across stocks, bonds, and currencies. Businesses are feeling this pressure too. Companies hate unpredictability. Stable costs allow businesses to plan hiring, investments, expansion, and pricing strategies more confidently. But volatile energy prices make planning far more difficult.